Hello and welcome to BQ Prime. A very good morning to all the viewers. I'm Iqbal Dadia. Joining us on the show today is Kapish Jain, CFO at IIFL Finance. Kapish, welcome to the show and congratulations for the good set of numbers that we've seen.
Thank you, Hiral. It's a pleasure to be here.
Kapish, my first question coming to you is we have seen an improvement in terms of the numbers. The asset quality has improved in this quarter as well. What is it that we've done right, to get onto this track?
So, Hiral, this has been a strategy over the last few quarters that we'll be focusing on the retail segment. We see enough appetite for growth in the segment where we're operating, whether it be the home loan segment, be it the gold loan segment, be it the microfinance segment. And therefore, we have been largely focusing on these product segments where we're operating. We have built our niche, we've built our distribution, we have built our strength by building our moat on all these particular segments to just then go and execute. And that has been making the difference for us. Clear focus, clear execution, and clear plan of how we want to go ahead and do this.
Right. So overall, if you see in terms of the overall loan AUM plus the core as well as the non-core, a similar kind of growth in that 5 to 6% range is what we've seen on a sequential basis. Year-on-year basis, yes, a 24 to 25% in the core, whereas non-core has seen a degrowth of around 7%. Any reason for that?
So non-core, as the word suggests, is something which is not core to us, which is not we are focusing on. It's largely the corporate or the wholesale book segment where we want to just mute it down further and just build ourselves on the core segments. So it's a clear reflection of what the organization is building itself towards.
Right. Overall, in terms of the asset quality as well, is this the kind of range that we expect to maintain from here on? Or do you see any pressure that could come in the fourth quarter?
So here, that is our endeavor. Our endeavor is to be at a range of gross NPA of around 2% and a net NPA of around 1%. And we have a clear plan. We have a team which is working on the ground, be it the collection team, be it the monitoring team, which is sitting in the central office from a risk management perspective. So we don't see any hiccups there in terms of maintaining these numbers. Across products, there could be some aberrations which can come in because each of the products are so distinct given the market in which they are operating. But we would still continue to have a focus to make sure that we are in that range of 2% of GNPA and 1% on the net NPA.
Right. Kapish, overall, in the last couple of years, we've actually gone ahead and revamped our strategy as well to make business more granular, diversified, and we've secure, a little more secured business as a whole, right? Due to which, if you see in terms of the share of high risk NPLs in sectors like commercial, as well as the capital market loans has gone down significantly to a single digit from almost a 16 to 17% that we'd seen in FY19. So is this going to be the strategy going forward? And overall, what's the kind of AUM growth that we could be expecting, on a CAGR basis in the next 2 to 3 years?
So here, the most important element for any organization is its consistency. Over the last 5 years, IIFL Finance has shown a CAGR growth on its AUM of around 25%. So this year is no surprise to that because it's a clear laid down plan and a strategy which is linked to the opportunity which is there in the market, the distribution that we need in the market, the channels, the people, and everything. So with that kind of a motive, we really want to make sure that we are on the same trajectory going forward as well. Our plan for the next couple of years continues to be what we have seen in the past, to be at 25% growth on the CAGR side. And that's something that we're going to maintain. And right. On the non-core assets which you mentioned, where you have seen the asset quality declining and overall asset quality also improving further, the non-core segment largely relates to the real estate segment. In the last couple of years, we did found a lot of challenges coming on the real estate side, be it liquidity, be it the COVID crisis as well. But now we see that there are those light at the end of the tunnel where we see a lot of improvements happening, projects going ahead and getting executed. The entire mind frame has changed because of RERA as well coming in, which suggests that the governance is far more better. With those kinds of positive signs that we see in this market, we also see improvements in our own asset book that we are holding. Although it's a very lower size asset book today compared to what it was 3 years back, but those improvement in the asset book performance as well is reflecting on the NPs on those asset class as well.
Right. So overall, if you see from a business perspective, clearly we have the branch expansion, which is already in place. People, technology, management bandwidth, all of this is already in place from a strategy perspective. Taking the run rate or the growth rate at what we are growing, Would it be fair to say that probably our AUMs could double in the next 3 to 4 years? Because otherwise, with this kind of a growth rate, if other things were not in place, it's an easy journey of 10 to 12 years for any company. So, with for us, I mean, do you think it's a 3 to 4 year journey to double the AUM?
So whatever that number throws out, I would take the 25% CAGR. So given that we had around 58, 60,000 crore, a 2 year CAGR will make it to around 95. A 3 year CAGR will make to around the number that you're suggesting, a double of where we are today. So maybe roughly speaking, a 3 year CAGR, a 3 year growth will touch us to that double the number that we are talking about to where we are today. And it's quite possible it'll surpass the 1 lakh number and maybe get closer to the double number that we all or what you are suggesting.
Right. And Kapish, overall, if you see, clearly our loan book is diversified, right? And we are present in our all high growth segments as well in terms of business. From here on, clearly it's an asset driven model, which in your specific segments from the retail segment also will be actually the cash cows or growth drivers for the business from here on.
So even if you see the asset mix there, you realize that the lead products for us has been the home loan and the gold loan. They have recorded 25% CAGR near around there. Microfinance segment has shown a little higher growth. But if you go into the background, you'll notice that over the last 3-4 years, NBFC's share of the MFI space has only come down. They are back to the 2018-19 levels. We clearly know the reasons. The reasons are about the crisis on the COVID crisis and others. So that segment has been very muted. That segment should give relatively better growth. It is also attached to the factor that the regulations has become far more acceptable and favorable. There's no capping on the rating with rate at which you can charge to your customer, which is making the risk reward far more conducive. Your ability to take higher exposure has also been made permissible. You can make that book far more balanced by doing unsecured products, doing some secured products as well, up to 25%. These will enable this segment to also grow and perform better. The performance on the ground also looks better in terms of recoveries and collections to support the asset quality part of that product segment as well. So we believe that the three of our core products, whether it's the home loan, gold, and microfinance, will give us the pedestal for growth over the next couple of years. A little more maybe in micro, but the micro share would continue to be in the 10 to 12% range of the overall book.
Right. And from a growth strategy as well, from an expansion strategy, what are the next steps that we would be taking as well to achieve all our milestones?
Yeah, so the next step would be one, for sure, to execute the way we have planned for ourselves with regard to leveraging the distribution that we have on our branches and the people, monetize the performance of our existing branches. We have expanded a lot in the last 8 to 9, 12 months. Leveraging those branches, building the growth in those branches will help us make sure that we are better efficient on our cost. Our cost might have spiked a little more, but then that's one avenue in which we can clearly get our cost down to lower levels. Our cost of borrowing is something that we would need to work for more aggressively. We have done well. If you realize in the last 9 months, while the market has moved up with regard to around 250 basis point increase on the repo rates, MCLR is going up by 100 basis points. Our cost of borrowing is more or less stagnant in the last 9 months. But having said that, there's still much and more opportunity. We would need to expand that space to get our borrowings even lower. That will help us get better margins. So these are the few aspects of our business which will help us in sustaining our growth going forward and getting to those financial variables like the way they have been in the past.
Right. Another question that I have is with regards to the return matrix, right? It's one of the best that we've seen in the industry as well. If you could just elaborate more in terms of the direct assignment business model that you have, how is it different, taking into consideration that we do a lot of securitization as well?
So, Hiral, the model is that since the IIFL crisis, NBFCs, what they really saw was a big jolt to them with regard to liquidity and managing assets as well. We want to make sure that we are well placed with regard to liquidity. We are well placed with our strategy on the on-book, off-book model, which largely means that I need to best optimize my capital. The best way to optimize your capital is manage assets, but do not have a capital charge on them. So we manage those off-book assets, which is currently standing around 35-37% of my total book. But I still have an entire ownership with regard to managing the quality of that book because I have a fiduciary responsibility with these banks. So if you see the performance of this book, they are as pristine as the performance of my on-book asset, which is enabling us to give the overall GNPA, which is that impressive that you see. Had I not had that kind of performance in the asset book, banks would not have come to me and bought these assets from me. So the model and the strategy would be that we want to best optimize our capital. And to best optimize our capital, we want to see that we do these kinds of assignment transactions where we are passing very pristine quality asset to the banks and managing them till their life, and show the kind of performance that we have shown in the past, so that we get the financial numbers or the ROE numbers that you see on that sheet. That's only possible because you're not charging capital for that asset. You get the revenue for that, and you're very disciplined and systematic with regard to tracking the performance of this off-book asset.
Right. And overall, Kapish, clearly from a, the way the rate cycles are moving right now globally as well as in India, what is the cost of funds coming up to? And secondly, what's the trend looking like in terms of interest rates?
So if I go to your second question first, the trend with regard to interest rates is extremely dynamic. RBI is harping to make sure that the inflation is kept in check, and that becomes extremely important for the economy as well. We believe the interest rates might be close to its peaking range. There could be another 25-30 basis point charge up which can come in on the repo or the MCLR. Incrementally, we are at organization level, we are borrowing at around 8.5, 8.75. Which is closer to the 9-month pricing that we see on our chart. There could be some repricing which can potentially come up on some of our floating rate borrowing, more particularly the bank rate borrowing. But we have been very active on our treasury side. If you see the reason why the pricing or the cost of borrowing is largely flat on our portfolio is because we in the last 9 months have been able to exit some of our high cost borrowing. We've been able to replace them with more market determined lower rate borrowings. We have negotiated with our banks to reprice our cost of borrowing for two reasons. One is the financial performance have been fairly good and decent, which makes us go higher on the internal credit parameters of those banks. And second is we've been holding a lot of liquidity. If you hold a lot of liquidity, you need not go and really show desperation to borrow. You can be far more comfortable in your borrowing program and give yourself space and time to negotiate on your pricing to go ahead before you close a deal on the borrowing. These are few elements which will make sure that we don't go too long we don't go too high on the borrowing rates, and we are able to manage it well. Having said that, in case there are events which make this borrowing cost shoot up higher for unknown reasons, we've been able to pass it on to the market. We've been able to get higher rates from our borrowers, but it always makes sure that it doesn't really spike up too much, and it doesn't really create too much of challenge and hit on their pockets.
Right. So Kapish, with this, if you see, even in terms of the cost ratios, right, do you think this is the year where we will actually see a lot of operating leverage that will start to kick in, and overall the cost to income ratio that was elevated at almost 40 will start to inch lower?
Yes, it will. It will, Hiral. That's a clear plan. That's one of the priority for the organization next year. Last 12 months, the focus was largely on our growth, largely to expand, take the benefit of the opportunity available in the market in terms of expanding to newer branches and new geographies. So with so much of expansion which has happened, a lot of new costs is coming into the system, new investments have happened. We had a lot of talent from the market as well, which is adding up to the cost. It's time to monetize them. And we believe that we should be able to bring this cost to income down in the next fiscal, significantly down. And that's something we are really working hard by closely monitoring the performance of the newer branches. How are they shaping? How is their overall individual cost to income looking like? And we track our performance at branch level. So with those kind of tracking, we see how the vintage branches are performing, how the newer branches are performing. Is there trend and trajectory of improvement in their performance? If not, what are the corrective measure interventions we need to bring into these branches? And basis that, we believe that we should be able to bring it down.
Right. All right, Kapish, thank you so much for speaking to us at DQ Prime and giving us the candid conversation. Thank you. Stay safe and speak to you soon again, and good luck for the coming quarters.
Thank you very much. It was a pleasure to be here, and wish you a great day ahead.
Wish you the same. Thanks.